Hit the like button, subscribe to the channel, and comment your top ticker right now. Retail thinks Bitcoin is the ultimate inflation hedge, but Wall Street knows gold has been quietly crushing crypto and the S&P 500 for years. The recent 30% drop is an algorithmic trap mirroring the 1973 recession. Today, we expose how institutions are dumping fiat to hoard physical assets.
Okay, let's get right into the data. And just a quick reminder, as always, this analysis is for educational purposes only. All trading, all investing, it involves significant risk of loss. So you have to do your own research. What we're doing here is mapping institutional capital flow, not handing out trade recommendations. The entire thesis for today is right there on your screen. While all the headlines are screaming about tech and crypto being the only game in town, the institutional money, the smart money, is quietly executing a massive rotation. They see the writing on the wall for fiat-dependent assets, and they need someone to sell to. That someone is retail. The entire mainstream narrative is a trap. Let me be perfectly clear. You are being positioned as their exit liquidity. What we're tracking in the dark pools, this isn't just some passing trend. It is a clear, systematic rotation. That recent 30% drop in gold, that wasn't some random technical breakdown. No way. It was a programmed algorithmic trap, a liquidity sweep designed specifically to shake out weak hands and to create institutional entry points. And it's mirroring the exact patterns we saw right before the deep recessions of 1973 and 2008. So today, we're breaking down that institutional playbook.
All right, let's just cut through all the noise and look at the hard data, because the numbers, well, they don't lie. While the financial media is obsessed with tech stocks and crypto's every move, the simple math tells the real story. Look at gold. It's up over 40% in the last year, decisively outperforming the S&P 500. And Bitcoin? It's not just lagging behind, it's down double digits year to date. This isn't an opinion, okay? This is the mathematical reality that the big institutions are trading on while everyone else is chasing headlines. And this chart, this is where the institutional playbook becomes absolutely undeniable. So I want you to look closely at your screen. First, check out the Bitcoin to gold ratio we've got overlaid here. It is in a clear structural collapse. This is the macro level capital flow we're talking about, a flight out of what people think is digital scarcity and into historical hard value. Now, contrast that with the chart for Newmont, ticker NEM, the biggest gold miner on the planet. While that ratio is bleeding out, we're seeing massive dark pool accumulation right here. Notice the textbook bullish divergences on the RSI and the MACD. That signals weakening downside momentum. And look at this. See this massive VWAP absorption? That is the signature of institutional money defending key price levels, buying up every single share that retail sells in a panic. This isn't just market noise. This is calculated institutional positioning.
So what does all this technical jargon actually mean? Let's translate this into plain English. Here it is. Wall Street's algorithms are preparing for a brutal U.S. recession. They are systematically getting out of assets whose value depends on a healthy, credit-fueled economy. And yeah, that means broad tech and crypto. They're using retail's fear of missing out as their exit strategy. At the exact same time, they are rotating that capital into two very specific sectors that have absolute pricing power. Tier 1 hard assets, like the gold miners pulling value straight from the earth, and the physical layer of the AI grid.
And this is the other side of that trade, the one that's less obvious. The AI revolution doesn't just run on code, right? It runs on an unprecedented, a frankly staggering amount of carbon-free 24/7 baseload power. And that's where a company like Vistra, ticker VST, comes into play. With the second largest nuclear fleet in the country, it's not just another utility. It is the critical physical infrastructure that's going to power the hyperscale data centers. Institutions are rotating into assets that can name their own price. AI needs power, and Vistra has it. Simple as that. Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits. All right, so now let's game this out. We need to map out the potential scenarios for this trade, because there are really three primary paths from here, and you've got to be ready for all of them. Okay, the bull case, it's the most straightforward. A deep U.S. recession forces the Fed's hand. They've got no other choice but to fire up the printers again to monetize debt and save the system. This debases the dollar and acts like absolute rocket fuel for hard assets like gold, and of course, the physical AI grid, which both have inelastic demand. But the bear case is a global deflationary liquidity freeze. A major panic event causes a mad dash for US dollars, which spikes the DXY and creates a wrecking ball that drags all assets, and yes, I mean including gold, down to their deep structural support levels before the real move can even begin. But what about the true tail risk? The black swan. Yeah, this is the scenario that nobody even wants to talk about. The US government, desperate to save a collapsing treasury market, decides to severely tax or maybe even restrict private gold ownership. Why? To eliminate any competition for the dollar, just like they did back in 1933 with Executive Order 6102.
And this quote, this gets to the very heart of why physical gold is the ultimate crisis hedge. Its value is not a promise. Think about that. During the 2008 crisis, when counterparty risk, the risk that the other side of your trade just can't pay you, when that blew up the entire financial system, gold was one of the only assets that didn't depend on somebody else's balance sheet. It carries zero counterparty risk. That is its ultimate defense in a true black swan event. It simply exists.
So, knowing these risks are on the table, how do you even trade in this environment? Let's talk protocol. Structuring your capital defense is completely non-negotiable. This is how you stay in the game when volatility goes insane. You must run a strict capital defense protocol. Number 1, deploy OTO, one triggers other, brackets on every single entry. This defines your risk and your profit target before you even get in, taking emotion out of the equation. 2, use dynamic 2.5 times average true range-based trailing stops. This protects your baseline profit, but gives the trade enough room to breathe through volatility. And 3, you absolutely reject taking a long position on any asset that is trading below its 200-day moving average unless you have a direct hedge against it. You do not fight the primary institutional trend. Do not violate these rules. If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on the gold rotation and the tickers mentioned, $NEM and $VIST. We read every single one of them.